of Research at ICICIdirect.com, joining us on the show right now. Hi, Pankaj. Good morning, and it's been a great, seems like it's expected to be a great morning for the Indian markets as well. Help us understand that what's your view on the markets right now, and which are the sectors that you will be focusing on?
Yeah, hi, good morning. Thanks for having me. Overall, our sense is that Nifty earnings for next 2 years could be growing at about 12% compared to 2% what we have seen last year. Because a lot of things are going to sort of normalize. And accordingly, our target for Nifty is 27,000. So we feel very bullish on the markets across caps, be it large caps, mid cap, and small caps. Now, coming to sectors, what we prefer, there are two sectors which are clearly in our preference list. One is BFSI. I think we would expect credit growth to sort of recover going forward, which is sort of come down to 10% or even below than that. Largely because of the relaxation in terms of some of the norms which RBI had put in earlier. And banking overall is looking good from a valuation perspective also. On top of it, I think since October, our sense is that the FIs are no longer relatively negative on a big sector like BFSI. So that is one. The other is we feel that there will be revival in the capex cycle. Last April numbers, the overall central government capex has been up about 60% compared to last year. And I think most of the conditions are quite conducive for capex to overall pick up. So entire capex beneficiary, be it capital goods, cement, steel, infra, so all these sectors or segments are looking positive to us.
Okay, so that's on what you like. But Pankaj, hi, morning. What are you making of the sector churn that we are seeing in the market? Financials have been the market darling for a very long time now. You've had some up move come in IT, and now metal is showing some positivity. Do you believe the sector churn is here to stay, or do you believe that strong themes that we have seen continuing to be good so far could lead the market ahead?
So you're right. There's some sector churn definitely happening. For example, metal as a sector is down about 5% in last 1 year. But our sense is that post 12% kind of a safeguard duty numbers for some of the steel companies will start perking up, especially for a company like say Tata Steel, because overall sense is that we have seen about $10 kind of a decline in a key input, which is coking coal. That should help. On top of it, I think the price hike of 2,000 to 3,000 rupees, that is also going to sort of help. While the prices might be slightly soft near term because of the early monsoon. But we would want to believe that overall you will see better volume growth plus pricing benefit also sort of kicking in. So Tata Steel, for example, in steel is our top pick. Same is the case with, say, a sector like cement. That is another sector which hasn't done much from a price performance perspective. But our sense is that once the monsoon is over, you will see pick up both in terms of capacity utilization and also in terms of the volume growth. So from and also bet on the pricing as well. So from that perspective, that is another sector which we feel is looking good. One needs to be selective in a sector like auto. Auto is sort of disappointing from the perspective of a broader growth. You have only select segments which are sort of delivering well. But on the consumption side, one needs to be very selective. So again, preference would be real estate. You'll have select autos and hospitals and hotels is what we prefer.
All right, so let's watch out for those sectors that Pankaj just highlighted for us. But Sharan, I wanted to have your take on the OMC basket as well, because of late we have been tracking the movement in the crude oil prices very closely. And as a matter of fact, when crude oil prices cools off, the OMCs start buzzing around on the back of better margin expectation. And what we can see on the stock of HPCL as well as BPCL, they are getting indeed ready for a breakout. But the key question is whether one should participate in this particular rally or not. Sharan, help us with your analysis.
So, Shrishti, definitely I would suggest taking a long call, and I've been doing that from Monday, because whenever crude goes down, you see a sharp rally in these HPCL, BPCL, IOC. Even for a matter of fact, I think you can go long in MGL and IGL. Lower crude oil benefits them also. And MGL is almost on a verge of a big breakout after a very long consolidation, I think over a year, maybe even more. I think it's ready for a big breakout and it can retest its all-time high. For BPCL, targets of 350 to 370 cannot be ruled out. Again, 335 around about is a major resistance or a small resistance. Post that, I think you can see a sharp movement even for similar rallies in Hind Petro and IOC. So going ahead, the whole pack is very strong. It is very beneficial for them. Major of the risk is reduced because of lower crude oil prices, and I don't see crude oil prices going up very sharply in the near future. So over a positive sector, and I think it will move ahead very fast in the coming days.
Okay, so that's the take on that entire space. But let's move on to an exclusive story now. Sources tell ET now that the finance minister is scheduled to chair annual review meeting with the PSU banks. My colleague Prakash is joining us to give us more details on what we can expect to see on the agenda of this meeting. Prakash.
Yeah, that's an important development coming in as the finance minister is going to chair an important meeting with public sector banks, wherein the Secretary Department of Financial Services, heads of the public sector banks and other senior officials will be present. A very significant development coming in. This is an annual review meeting with public sector banks where their financial performance based on defined parameters will be reviewed. Along with that, some other issues are likely to be discussed as well, and one of them is, of course, declining deposit growth, which is a major concern for banks at this point of time. In fact, the finance minister had already given clear instruction and suggestions to the banks to take necessary steps to increase deposit growth. In fact, banks were told to announce some innovative product to attract depositors. Therefore, it is expected that the finance minister will be apprised by the banks about the steps they have taken so far and their strategy going forward. In addition to that, credit growth to sunrise sector is one area where the government is providing its focus. It is expected that the DFS secretary will make a presentation about the steps the department has taken so far. Issues such as digital infrastructure, cyber security, status of NPA recovery may come during course of discussion. Status of government's flagship scheme may be discussed as well, as the government is trying to achieve a saturation in various sectors.
Thank you so much. All right, thank you so much, Prakash, for getting us all those details on the finance minister's meeting that is likely with the public sector banks. But Pankaj, I just wanted to have your take on what sort of a sense you are getting on the public sector bank side, because though you are positive on financials, but the interest is not really getting into the public sector banking space, and we also have news flow suggesting that SBI is getting ready for a very big QIP. Amidst all of this, do you believe that is there any pocket or any stock that you can highlight for us which looks good, and what's the overall sense?
Oh yes, so within banks we are relatively more positive on PSU banks, largely because for them the proportionate share of external benchmark linked rates is higher, so their impact on the margins is expected to be lesser. Just to sort of put some number, we were expecting about 12 to 13 odd bips kind of a decline in margins for a bank like HDFC Bank. And I think some bit of a recouping of this will happen because of the CRR cut to the tune of about 4 to 5 bips. But relatively, PSU banks will face lesser margin pressure. And I think credit growth for them is largely on similar lines what you see for private banks. So SBI I can't talk about, but in PSUs, I think what we're clearly liking is Indian Bank. This is one of the few banks which has consistently maintained ROAs of about 1.3, and we feel that there's a decent amount of valuation catch-up to sort of happen. There we have a target price of 740, but in general, we are liking relatively PSU banks more compared to private counterparts.
Okay, so interesting take coming in where Pankaj is preferring the PSU pack over the private space. But Kunal, let's move away from banks and let's talk about realty. At 9:40, we will be discussing real estate with a whole host of experts. But as of now, Kunal, this is a sector that has largely underperformed the market yesterday. You had some segments of the market that were inching fresh highs, and then you have Nifty realty that's 1% down in a market like this. Do you believe this is only purely profit booking, or are the charts looking inherently weak?
Yeah, the charts are looking a bit mixed. They're not looking very strong. Neither, there are charts which are looking extremely weak for the real estate pack. For example, you look at the charts for Macrotech Developers, Luda. That's a stock which has been doing reasonably well, perched above its longer term averages, and has been recovering quite well, been more steady in terms of the chart trends. We look at DLF, the stock has been hovering around the 800 to 850 plus mark for quite some time, and even in the last I think few weeks of the market trend, heightened volatility, the stock still remained to be into this zone, and then given a slightly breakout above the 850 plus mark. The only underperformer I think in the pack, which I was looking at the charts on a relative basis, has been Godrej Properties. The stock has been unable to break past above its 200 DMA. I think that level is around 2480, 2500 for the stock on the spot levels. And there have been 3-4 attempts for the stock to break past about those levels, but it's not managed to surpass the resistance. So I think there are very few names which have actually shown signs of strength. There are few stocks which are emerging as potential breakout candidates, and there are just very handful few which have still not confirmed a breakout for themselves. So that makes the entire real estate pack a little bit more mixed rather, and not on the extreme strong side. And that's one of the major reasons why I believe that when the markets were seeing a buying yesterday, real estate stocks did not see too many takers.
All right, so that's the take coming in on the real estate stocks. But Pankaj, help us with your take on big boy Reliance and help us understand that what, as per you, is getting a lot of investor interest, or rather renewed investor interest in this particular counter, because of late we are not just seeing that the stock is perking higher, but there are a lot of brokerage reports indicating that they are now bullish more on the retail side of the business. What's the sense that you are getting, and any big targets on this one?
So on the Reliance, I think one is we have seen the bulk of the selling happening in a sector like oil and gas, and my sense is that will be Reliance from the FI perspective. But of late, last 2 months, there are no major incremental selling, so that way they are no longer negative. And Reliance, we are more positive on the telecom aspect of the business. What we are sort of penciling is about 10% kind of a tariff hike. And overall sense is that in case if the tariff hike is higher, then that should sort of help. Overall, from a valuation perspective, also Jio is carrying a higher weightage, or is driving the higher multiples for Reliance. On the refining side, there could be marginal improvement in the JRM, so that might sort of help. I think retail is still a long way in terms of to sort of contribute meaningfully. They are sort of still consolidating, and we haven't seen most of your retail players, especially say for example in a segment like apparel, doing well, except for a company like Trent. So I think that is one segment which is still sort of struggling. So that business is we are still not very positive on, but Jio I think can do a lot more better going forward, and also if the IPO sort of is priced attractively, things can be a lot more better for a company like Reliance.
Okay, so that's the take on Reliance, but let's move away from that and bring you the latest from the regulator, because SEBI has extended its rebalancing timeline rule to cover all passive mutual funds and not just select categories. The regulator now allows more time for funds to adjust portfolios when they deviate from their benchmark allocations, aiming to reduce fire sales and tracking errors. Ankur is joining us with the fine print of this new update coming in from SEBI. Ankur.
SEBI has now given a kind of clarification and not an order that for all type of passive breaches, the timeline needs to be adhered. Earlier, it was only for asset allocation. Now it will apply uniformly for all the passive breaches. Now, what is a passive breach? It is an unintentional kind of a rebalancing which happened, not necessarily by AMC, but maybe due to price movement, corporate action. This kind of rebalancing happened, and later on the asset allocation or the AMC needs to rebalance it to the timeline given earlier was 30 days, and now after this new directive, SEBI expects that all these passive breaches needs to be corrected within the timeline. Now this is important according to market regulator, because there is a risk which is associated with all these passive breaches. Although active breaches are considered to be something where penalties are there by SEBI, but for passive breaches there is a timeline which is given for rebalancing.
Why am I hitting a pause button here? Because if I take HDFC Bank outside, the market would have hit a pause button yesterday. While we can feel excited about the market action, if I take HDFC Bank, there was nothing apart from HDFC Bank.
No, I think Nikunj, yesterday was a classic day. You had Reliance, you had L&T.
No, that big forward what we use.
That's because of the weightage of HDFC Bank, and it was missing. That was the point. We were discussing this in the morning yesterday, that the large cap stocks, they were missing that zing in terms of breakout. It was difficult to call that which are the sectors within the large caps which have more weightage, which could probably try and take the heavyweight price action. But then it was good to see that many of the large cap stocks, they played their own share, I would say, in terms of helping the index move up higher. So I think yesterday was one of the classic days. HDFC Bank, I think after for the first time the stock crossed the levels of 2000, and it ended almost like a 3 month of a major consolidation. You still have ICICI Bank, which is lagging a little behind in terms of the price highs, but the stock also did its fair part, crossing the levels of 1440. Axis Bank did pretty well. Reliance, L&T, Bajaj Finance, Finserv. So there was slew of large cap names.
Pankaj Pandey, they say there is a piper effect in the market. Large caps, they move up, and when they start moving up, they have this piper effect. So can I say that it's soon going to be the mid-cap private banks, and then the mid-cap PSU banks, and then the smaller private banks, then the smaller PSU banks?
Oh yes, so I think large banks have started to do well, especially a bank like HDFC Bank, where we have a target price of about 2200. Our sense is that a lot of these relaxations which have started to sort of come from RBI is pretty positive. Take a look at a segment like, say, banks loan to NBFCs. Now that segment used to sort of grow in double digits. Literally, it was flat last year. So with RBI's relaxation, we would want to believe that overall you will see far more better credit growth for the banking as overall pack. And I think of all the major sector, bank is the only sector where the valuations are sort of okay or reasonable, I would say. Whereas a lot of sectors, the valuations are sort of rich. So I think banking, our sense is that is going to do the heavy lifting in the near to medium term. And I think all signs are placed for the sectors to sort of do well. And eventually, it will percolate to tier 2 banks and also to even the smaller banks. And I think NBFCs relatively will do slightly better in the near to medium term, largely because of the lesser impact or also because of the fact that the overall margin decline is expected to be a lot more lesser for them. In fact, it's beneficial for them.
So Kunal, what's next for HDFC Bank? Another 200 rupees is coming?
Maybe not 200.
100?
Yeah,
50?
100, I think 80 to 100 should be there. 80 to 100 should be there. So I think closer to 2100 should be there for HDFC Bank. But the only concern is that, these are large cap heavyweight names. Even if you look at a 5% upside, we generally don't expect that those upside happens in 1-2 weeks or so. They take a little bit of a prolonged time as such in terms of a stretch of 5%. But then yes, the path for HDFC Bank towards that 2100 mark, I think should be on.
Pankaj, of late, the digital stocks have taken a step back. Zomato, Paytm. I'm just talking about the near-term price action. Is it in line with this broader sectoral rotation?
I think, Nikunj, probably the challenge with some of these new age companies is that the path to profitability is still sort of not very clear. So we are very selective in this entire space. What we're liking in new age companies is something like, say, for example, Dixon or Sirma, where our sense is that the opportunity pie is quite large. So for a company like Dixon, our target is 20,000. We feel that they can grow their top line by about closer to 35-37% odd. Bottom line growth could be even more higher, given the fact that we would expect a higher value addition, and accordingly, margin should perk up. But I think one needs to be very selective because a lot of these businesses are already getting very rich multiples, and if path to profitability is not very clear, then somewhere down the line, you can't expect a sustained performance from most of them.
Okay. I like real estate. That's what Neelkanth Mishra told us a couple of days ago. He said that real estate is one space where action and excitement clearly seems to be setting it up. Real estate in general, I think, has been in a good groove, so to speak. I'm just going to get one more comment from Pankaj, and then we'll do a chart check with our technical experts. I just want to focus on NBFCs. Pankaj, RBI has cut rates, and NBFCs have not really responded to that. I mean, I was hoping that when that 100 bips bazooka was fired, and we are talking about 100 bips, another 50 maybe before the year end, that makes it about 200 bips combined. NBFC stock should be doing cartwheels.
So I think historically, or last 1 or 2 years, we have seen a bit of a challenge for some of the NBFCs. Like I said, the credit growth from banks to NBFCs has sort of come down, and it's a big pie because see, of the overall credit of nearly 180 lakh crores, 50,000 odd crores is from services, and 1/3 of that is literally going to NBFCs. So from that perspective, that is a challenge. And I think some of the consumption categories are also not doing very well. The likes of auto, we haven't seen much of a pickup, even in the last 2 months, despite the expectation that tax cuts should have helped. So from that perspective, NBFCs have been not really sort of performing optimally. But our sense is that in the second half, a lot of these things should sort of improve. And I think one needs to be, again, be with the tier 1 or bigger one NBFCs like Bajaj Finance or Shriram Finance. I think those are the ones, or probably L&T Finance. So those are the ones which we like.
Okay, so that's on some of those NBFC names and select auto counters. But Sharan, give us a chart check on some of these NBFC names that you are liking, if at all you are liking anything from this space at the moment, because the flavor of the market among the financials is what we're seeing right now is with private and PSU banks. Amid all of this, how do you think the NBFCs rank compared to these, and what are you liking?
So Snehi, I think my top pick today is Shriram Finance itself. Your next pick should be Cholamandalam Finance. All are looking for a very good breakout towards all-time high. And if you see, L&T Finance is already trading at all-time high, AB Capital all-time high. So already the moves have started. Leaders are showing themselves to the market. So I think NBFC won't lag. Even others will take a very fast uptick looking at the leaders. So I see a good moment for NBFCs, even for PSU banks equally. And I think they will lead, and I will be as a leading sector compared to Nifty, and they will outperform Nifty and Bank Nifty going ahead.
All right, so that's the take coming in on NBFCs. But Pankaj, just wanted to have your take on the FMCG pack, and especially the staples, because just the headline I was reading this morning, which says that the edible oil prices have seen a decline. And in the past 3 days, the palm oil prices fell by $30 per ton. Soybean and even sunflower prices have also dropped $10 to $20. But that's about the international market. But back home, the demand really has to pick up. But do you believe that because of these raw material prices inching lower, the margin push can be there, and now is the time because of the fall in the prices maybe somebody can look at?
On the FMCG, I think this is one sector which is clearly lagging, whether you look at from a recent recovery or even from a last 1 year perspective. And I don't see much of a hope for this sector to sort of do well. While yes, some of the raw material prices have corrected, and that should sort of lead to better margins or some improvement in the margins from Q2 onwards. But in general, the volume growth has been tepid. Even a big player like HUL now is focusing more on volume growth, because I think one point of time, most of these FMCG companies had driven the premiumization theme, which is why their margins were at a lifetime high. But that has sort of backfired to some extent, and now they're looking to sort of recoup some of the volume growth. For this sector to sort of do well, I think you need GDP growth rate more than 7-8 odd percent. You need a lot more job creation, and that is when you'll get fresh blood in the market. So from that perspective, I think we are still some time away. So I don't really see much of a hope for this sector to sort of do well.
Okay. Pankaj cannot talk about ICICI Bank, but Kunal can talk about ICICI Bank.
It's one of the picks which I have given today.
Can it do what HDFC Bank did yesterday?
It should do. it's been high time, Franklin Kunsh. And I think ICICI Bank has been a big disappointment rather than HDFC Bank in the last